Hello, thanks for watching, welcome back to the next video in my series. Now, as usual, a few things before we get started. Please feel free to follow me here on YouTube, Facebook, TikTok, or Telegram. That's way when I upload a new video, you know about it, and it's always nice to connect with my viewers online. If you like the video, please give the thumbs up, share it with classmates or colleagues, or put it on a playlist. That does encourage me to keep making them for you. If you think there's something I can do better, please leave a comment below the video, and I will take those ideas into account when I make new ones. Let's get started.
Setting accounting principles. Sets both broad and specific principles. Accounting principles encompass both overarching guidelines and detailed rules for financial reporting. These principles ensure that financial statements are prepared in a consistent and standardized manner. Establishes reporting requirements for companies that issue stock to the public. Publicly traded companies are required to adhere to specific accounting principles and reporting standards. This ensures transparency and comparability for investors and other stakeholders. Identifies preferred accounting practices. While there may be some flexibility in accounting methods, accounting principles often provide guidance on preferred practices. This helps to promote consistency and reduce the risk of manipulation. Key points. The primary goal of accounting principles is to ensure that financial statements are complete, consistent, and comparable. Generally accepted accounting principles, GAAP, are the primary accounting standards used in the United States. The Financial Accounting Standards Board, FASB, is responsible for setting GAAP. International Financial Reporting Standards, IFRS, are used in many other countries. Accounting principles help to mitigate accounting fraud by increasing transparency. Additional considerations. Matching principle requires that expenses be matched to the revenues they generate. Materiality principle. Only information that would influence the decisions of users needs to be disclosed. Full disclosure principle. All material information should be included in financial statements. Going concern principle assumes that a company will continue to operate in the foreseeable future. In conclusion, setting accounting principles is essential for ensuring the reliability and comparability of financial reporting. These principles provide a framework for companies to follow, which helps to protect investors and other stakeholders. 1. Objectivity principle. What it means: accountants should strive to be impartial and free from bias. The numbers in financial reports shouldn't be influenced by personal opinions or feelings. Why it matters. Objectivity ensures that financial information is reliable and trustworthy. If accounting was subjective, every business could present their finances in the most favorable light, regardless of reality. How it's achieved. Verifiable evidence. Transactions are recorded based on things like receipts, invoices, bank statements, documents that provide solid proof. Standard practices. Accountants follow established rules, generally accepted accounting principles or GAAP, to ensure consistency and reduce subjectivity. 2. Cost principle. What it means: assets are recorded at their original cost at the time of purchase. Why it matters. Historical cost provides a stable and verifiable benchmark. While the market value of things might fluctuate, the original cost remains a fixed point of reference. Example: if a company buys a building for $100,000, it's recorded at that price, even if a year later the building's estimated value increases to $120,000. 3. Going concern principle. What it means: accountants assume that a business will continue to operate in the foreseeable future. Why it matters. This principle influences how assets and liabilities are valued and reported. Example: a company invests in a new machine with a 10-year lifespan. Because of the going concern principle, they can depreciate, spread out the cost of that machine over its useful life. If they assumed they were going out of business next year, they'd have to account for the entire cost immediately. In essence, these principles work together to make financial information reliable. You can trust the numbers. Consistent. Different companies use similar methods, making it easier to compare them. Useful. The information helps make informed decisions. These are all important accounting principles that help ensure financial reporting is accurate and consistent. Here's a breakdown of each. 1. Monetary unit principle. What it means. This principle basically says that accounting records should only include transactions that can be expressed in a monetary unit, like dollars, euros, yen, etc. This provides a common and consistent way to measure and compare financial information. Why it's important. Imagine trying to compare the value of a company that reports profits in apples to one that reports profits in gold bars. It would be impossible. Using a monetary unit provides a standardized way to track financial performance and make meaningful comparisons between different businesses or time periods. Example: a company purchases a new machine for $10,000. This transaction is recorded in the accounting system using the monetary value of the machine. 2. Revenue recognition principle. What it means. This principle dictates that revenue should be recognized when it's earned, not necessarily when cash is received. This means that a company records revenue when it has delivered goods or services to a customer, regardless of when the customer actually pays. Why it's important. This principle prevents companies from manipulating their financial performance by delaying or accelerating the recording of revenue. It provides a more accurate picture of when a company actually earns its income. Example: a company sells a product on credit for $1,000. Even though the company hasn't received the cash yet, it would recognize $1,000 in revenue at the time of the sale because it has fulfilled its obligation to the customer. 3. Business entity principle. What it means. This principle emphasizes that a business is a separate entity from its owners and any other businesses. The business's financial transactions should be kept completely distinct from the personal transactions of its owner. Why it's important. This separation is crucial for accurately assessing the financial performance of the business. It prevents the commingling of personal and business assets and liabilities, which could lead to a distorted view of the business's true financial position. Example: if a business owner takes money from the company's cash register for personal use, this needs to be recorded as a withdrawal or loan, not as a business expense. This ensures the business's financial records accurately reflect its own transactions. These principles, along with others like the matching principle and the going concern principle, form the foundation of modern accounting. They help to ensure that financial reporting is reliable, consistent, and comparable across different businesses and time periods.
Finally, if you like the video, please give it a thumbs up and share it with classmates or colleagues. Please feel free to follow me here on YouTube, Facebook, TikTok, or Telegram. It's always nice to hear from you. If you think there's something I can do better, please leave a comment below the video. So, thank you very much for watching. I wish you the best of luck in your work and studies. I look forward to seeing you again next time.